Hi, this is Jack from Alpha Charts with an experiment week 12 update. This is the final week and these are the results. Before we get started, this video is for educational purposes only. These are not recommendations to buy, sell, or hold any stock or security. I may hold positions in some of the equities mentioned near your time frame and risk tolerance. Also, if you enjoyed these videos and these types of videos, please like and subscribe to my YouTube channel. And also, I'm on Twitter at AlphaCharge365. So go ahead and give me a like and a follow over there if you want to. All right, so week 12 is done, and this is the spreadsheet. So let's go over what we found out. All right, so as you can see, I sorted this by best performing. So the Qs over the last 12 weeks are up 20.79%, SPY 11.49, and the Russell is up 11.31%. All right, so you can see the Qs are obviously outperforming by a lot. But now, before we even go into my stocks, the whole point of this video is to determine, one, if my stock selection criteria is effective. Also to find out if my stops are properly placed. Meaning in this experiment, it was a June 1st buy regardless of setup with a 10% maximum drawdown. And then I went ahead and plotted the ending week, ending price for every stock on Friday, and you can see what happened here. Now, green means that it is positive and made money from the buy price. Yellow means that it is below the buy price, but hasn't hit the 10% stop from the original buy price. Red is it has hit below the 10% stop. Okay. You'll see purple and you'll see brown. Purple is because I like to, one of the things that I currently do in my risk management is I look for 2 closes below the 23-day EMA, and then I use that as a stop for me. All right. And what I also did was I also plotted the 65-day EMA, and that's this brown color right here. And if there are 2 closes below the 65-day EMA, I went ahead and plotted, showed you where that was, okay? And we are going to go ahead and look at some numbers. Also, on these percentages, you'll see if it's dark green, it's over 10%. If it's light green, it was a plus from 0 to up to 10%. Yellow is minus, but not below the stop. And the red means that we got stopped out. All right, so look at the numbers. You see that Square was by far the best gainer. It's up 91% in the last 12 weeks. Congrats if anybody was long in Square. Etsy also 61% up, right? SolarEdge, $50, 50% up. Now, the interesting about SolarEdge was that it took a really bad tumble right here in week 4. And so, chances are I would have been stopped out of this particular name, but it went ahead and really came back, with most of the solar stocks and did very, very well. So that's good information right there. The trade desk is up 48%, HubSpot 42, Coupa 32, CrowdStrike 27, Twilio 27, and you see all the way down. I don't need to tell you every percentage. But here's the cool thing. So when I look at the average, again, assuming this was all equal weight, I without selling it, just buy and hold, not selling, I would have been up 21.76%, which includes this Alteryx huge gap down over here, right? That was a disaster right there in Alteryx. So even though I have a big loss on this particular one, and Atlassian also wasn't so good, and IFI, Infi, it wasn't so good. Still, there was about 1% outperformance. Nothing to write home about, but buy and hold did very well. Now, when we go back and look and say, okay, this went ahead and said, if it's purple, that was my stop. So I ranged these and 2 closes below the 23-day EMA. And if you look over here, I would have underperformed pretty significantly just by buying the Qs by using this stop method. So I think that was really, really good information. And by using the 65-day EMA, I would have done roughly the same as the Qs and slightly under buy and hold. But look at the outperformance from the 23-day to the 65-day. And I think that's really good information too. So let's go to some charts. I want to pull some of these up and we can kind of see what that looks like on the chart. Okay. So here's the Qs. As you can see, beautiful uptrend. Nothing bad there. And let's look at Square, the best performer. So Square, was bought hypothetically June 1st, which was actually a perfect, buy point, just as it's breaking out, slight little retest, and basically moved higher, right? June 1st was like just absolutely perfect. So buying right, that's another takeaway from this, right? This one was bought right, and boom, went straight up. Look at it. It barely touched the 23-day EMA, let alone the 65. So the way I do my risk management, and in my education section, there's a whole video on my risk management. But basically, I offensively sell at 5% and 20%, and the last bit is let it ride. Up to this point, I've been using the 23-day EMA as my stop. What I am looking at now is potentially using the 65-day EMA to give it some more room on the let it ride portion. So still use the 23-day if I'm for the 5 into 20%, and the 65-day EMA just for that smaller last 1/3 portion. Again, if you want more information on that, check out that in my YouTube video. All right, looking at Etsy. Once again, Etsy. Beautiful, never had 2 closes below the 23-day EMA, very strong stock, and never even came close to the 65-day, right? Now, let's look at Solar Edge. Now, Solar Edge, June 1st was right here, and this was that shakeout. But look how it kept the 65-day. So that was interesting. I would not have been shaking out Solar Edge at all if using the 65-day as my stop. And even if I got stopped out, should have probably jumped back in it, probably on, somewhere on the 14th, and then still captured this beautiful uptrend right here. So that was interesting. Solar Edge. What else? Whichever one. Coupa. Let's look at Coupa. So Coupa on June 1st was right here, and there was this big pullback, 23-day held, has held since. Now, again, offensively selling, I would have been out. I would have been just had 1/3 and could have tolerated this type of sideways consolidation using the 65-day as my new stop. Again, it's a wide stop, but it's a small 1/3 position, so I can feel comfortable doing that. It's just within my my risk tolerance. So it's consolidating and looks like it wants higher potentially, right? We'll see what happens, but the prior trend is higher. And this, so that's why the 65-day kind of makes sense after a big run, because it gives it time to go through a new basing consolidation type phase. So this is why I'm thinking about making the let it ride shares using the 65-day EMA as my stop. So let's look at some rougher ones. Let's look at MDLA. So MDLA, June 1st was right here, and then it literally looked terrible after that. I mean, just literally, I bought it here and went straight down. So that would have got me out no matter what. But I do like how it held a 65-day here, held a 65-day here, starting to move up. You do have this, it is above the volume weighted average price now, and from the IPO. And I mean, this chart looks like it's still setting up well. This buy point was, extended, right? I mean, it just boom, retraced, and now kind of is moving higher. So I would have been stopped out of this one. It's just the way it would have went, and I would have been stopped out literally first week. Nothing would have changed. What else? Let's look at here. EVBG was just a rough one the whole way, right? I mean, June 1st was right, here, and already made a lower high. Okay. And then boom, there's just like MDLA, vertical violation. I would have been out first week. And really has just kind of moved sideways since. So has gone through this big, long looking consolidation. But yeah, I mean, you can't help that. Sometimes you buy a stock and it just violates it immediately and it's out. And so EVBG would have been out week 1, no questions asked. And let's look at the last one is Alteryx. So this one was doing great, right? June 1st was right here, right? A little pullback, never closed twice below the 23-day. Nice trending higher, would have taken my offensive profits. This day looked pretty rough. Took it over again. 1 closed below, 2 closed below, 3 closed below. This would have taken me out based on that 23-day stop. If I had already sold my 20% and changed it to 65-day though, I would have let this ride. No big deal. Earnings coming up. I would have let it ride. It's a 1/3 share. And then the huge gap down. Now, I would have been out here. A gap down like this would have been taking me out for sure. But that was a absolute disaster. And that's why holding through earnings is, a crapshoot. Sometimes you get amazing gaps up, and sometimes you get this just gigantic gap down. I mean, from 30%, 31% gap down. And that's the risk of holding through earnings. And that's why, for me, if I'm going to hold through earnings, I want to usually be a very small position size and very, have a lot of cushion in case this happens and you get out. And, you can't help that if you choose to hold through earnings. It's just the way it is. So those were some of the highlights of the stocks and just kind of what I'm looking at. So I really did like how, let's move this over here, spread back to the spreadsheet. I do like how most of these offensively would have worked with my type of risk management using 2 closes below the 23-day. No, again, these were problem children, and they remained the entire time problem children. It's better to cut your loss and your emotional capital from these, recycle that money into other potential winners, and potentially outperform. That's the other thing that this did not do. It never went into other potential winners. It just followed the whole thing. So, I mean, something like these, I would have loved to recycle through, and even Atlassian here, just cut it and move on, and again recycle this into other potential winners, and hopefully you get nice big runs, more like the Square, Etsy's, and Solar Edges, versus things like Infi, Atlassian, and Alteryx. Well, I hope this was a good experiment with you guys. I really did learn a lot. I think I will be moving my Let It Ride shares using the 65-day EMA. Again, understanding that you could get these big gaps, but you're also very likely in a nice trending market to get these huge runs also. So that is something that I will be changing in my personal trading style going forward. And you'll see in my charts, I'll start using the 65-day 8-day EMA more with the 23-day, and I like the 9-day for ultra short time. And if it tells me the short trend. All right. Well, again, thanks for going along this ride with me. Appreciate any comments that you have on this, or any more any ideas for future experiments like this, because I think there's a lot to be learned. Take care. Again, like and subscribe if you do like these videos. Hope you all have a great day. Thanks.